Hello, everyone, and welcome in to this ETF.com webinar on the presidential election and its impact on your portfolios. I am super excited for this conversation. I think it's one that's going to be incredibly interesting. It's October 22nd, so we're now less than a month away from the election, only a couple of weeks away. So I'm really excited to have this conversation with these three amazing guests about how the presidential election could impact your portfolios. So I'm joined today by Kim Wallace. He's a senior managing director and head of Washington policy research at 22V Research. We also have Kristina Hooper. She's the chief global strategist for Invesco. And last but certainly not least, we've got Anu Ganti, who is the U.S. head of index investment strategy for S&P Dow Jones Indices. Now, before we start this webinar, I do want to go over some really quick housekeeping notes. Now, at the bottom of your screens, you're going to be seeing a button that's actually called Resources. Now, we've had some guests actually provide some really great slides that you guys will be able to utilize and follow along with during this conversation that really goes a little bit more in depth to what we're going to be discussing today. So if you go and click on that Resources button, you'll be able to see presidential election slides, which you can download and follow along. Again, there are going to be some slides and resources that have been provided by Kim Wallace from 22V Research and also Anu Ganti from S&P Dow Jones Indices. So just want to give you all a second just to click that button and to download any of those resources at this time. All right, let's get right into it. We have a lot to cover right now and only a short amount of time in which we're going to be able to cover it. So I first want to really start with what's at stake in this year's election, 2024. Just as a reminder, again, we've got the Republican candidate, that's Donald Trump, and the Democratic candidate, that's Kamala Harris, the current vice president. Just as a reminder, because Biden is no longer running in this race, though he once was just a couple of months ago. So, Kim, I know you kind of talk about this a lot, and your slides really detail kind of some of your preliminary thoughts. So I'm hoping you can talk to us a little bit just about some of those risks that you're seeing, particularly when it comes to the fiscal policy. You mentioned it over the next 5 to 6 quarters. So we're really looking at the next 12 to 18 months. Can you talk to us a little bit about some of those risks, especially for this election?
Well, there are risks today, but they may turn out to be opportunities once we get there. So it's all predicated on the expiration of individual tax cuts that were passed in 2017. Just as an aside, the corporate rate was changed into permanent law. Doesn't mean it stays permanent. It just is not going to expire at the end of 2025. It might be the subject of negotiation, but it's not automatically set to expire. My sense is that we are going to endure 4.5 quarters of discussion, some of it loud, some of it possibly relevant, until we get to deal making in the fourth quarter of next year, sometime, just before November. And I expect they'll finish a week or so before the year-end holidays next year. One of the issues that has sprung up the last week or so is the impact of expectations on calendar 25 fiscal policy on yields now. I am firmly of the view, and I'll walk through it quickly, that both the business cycle and the rate cycle will impact and are impacting yields much more on a sustainable basis than a fiscal policy. Fiscal policy is a volatility trade right now, part of the election outlook. But when you look at the possible or the likely outcomes of the election, whether it's unified, red or blue, or divided, which is our call, margins are going to be tight again. They've been tight on Capitol Hill for 10 or 12 years. Our expectation is they will continue to be tight. Of course, we can be surprised, but we'll find out in 2 weeks or a little bit more after 2 weeks. So the big thing to pay attention to when you're thinking about tax cuts and fiscal policy is first the baseline. Baseline is current law. So the Congressional Budget Office publishes frequently. You will see, if you look at their work, you will see an increase in revenues, federal revenues in fiscal 26 and again in fiscal 27. That is the expiration of those tax cuts. No one expects that to happen, especially no one in the markets. Very likely you'll have a negotiated settlement, again, irrespective of the balance of power after the election, a negotiated settlement that renews some of them, allows some of them to expire, some will be modified, and depending on the president, that's the driver to watch, I think, for the second half of next year, how this will begin to unfold, or at least the preferences that will dominate.
Christine, I saw you nodding along a bit. Anything to add there to what Kim was just sharing?
No, I think that's going to be a significant driver of potentially positive market sentiment because markets get excited over tax cuts. But I do think a lot of it has to do with where we actually see the tax cuts. But just a general observation.
So on a sector basis, I'm wondering what you guys are kind of seeing in terms of really what's kind of like at stake here for this election, because obviously we have heard, that markets kind of, they tend to look past elections, but we do have two incredibly different candidates that have come out and said that they have very different policies in place for a lot of different sectors. I mean, I'm thinking when it comes to trade, obviously taxes, as we kind of mentioned, we do have some tax provisions that are expiring, but won't be expiring for a while. We've heard about tax cuts. We've heard about tax hikes on certain populations of the country. We've heard about infrastructure, energy. So there do seem to be a lot of potential sector implications. Are you guys reading the kind of lay of the land in the same sort of way?
If you want me to start, I'm going to be a bit of a contrarian and say that sometimes we see an impact on sectors, sometimes we don't. But when we do see an impact on sectors, it can often be not what you would expect. And I'll give a case in point around energy. Obviously, different policies as it relates to energy. What we saw in the first Trump administration was that there was obviously support for traditional energy, for fossil fuels, and support for drilling and producing as much as possible. Interestingly, during that period, we saw energy stocks underperform. Ironically, it was and clean energy stocks perform better. Ironically, it was under the Biden administration, which obviously not as supportive of fossil fuels, where we saw energy stocks perform better. Now, of course, if we think about it, when there is more production, all else being equal, prices come down, and that means lower profit margins for a number of energy stocks. So that could certainly be part of the equation. The other part of the equation, which really has nothing to do with which administration is in power, is that two wars in the world started during the Biden administration. So that can also drive up oil prices, especially depending upon where that conflict is geographically. So all of this is meant to say that sometimes what we think might happen isn't actually what happens. And I've found a number of cases looking back at history where the results on a sector level were counterintuitive.
And just adding on to that, Kristina, as you were talking about the element of surprise, I think we can go back to 2016, right? If you think about the aftermath of 2016, there was a huge element of surprise there, and we saw that the S&P 500 rose 4% in November, but there was a whopping 19% spread among sectors. If you think about the top performing sector, financials, right, versus the worst performing sector, utilities. So knowing in advance who the potential winner was going to be, as well as the potential sectoral implications, could have been a big advantage potentially for managers and for investors. So I think it's important kind of as we start this conversation to keep that in mind, that none of us really knows what is going to happen in the future, but sectors are certainly top of mind. We've done a lot of research on history and the importance of sectors in elections. And one common measure that we'll talk about a lot is dispersion, or just the spread of returns within an index. And you can measure the spread at the stock level, you can measure the spread at the sector level. And sectors, while stock level dispersion is always going to be greater than sectors, because there's 500 constituents in the S&P 500 as opposed to 11 gig sectors. Sectors have something unique going for them, which is capacity. The capitalization of the average sector is roughly 10 times greater than that of the average stock. So important to keep sectors in mind as we approach this impending election.
And we are going to go into that and dive more deeply into that a little bit later in the conversation. I want to go to you, Kim, because I saw you came off mute, so I have a feeling you have something to add in here as well.
Well, it follows on the comments of my co-panelist. Surprise is always an element of politics and policy, but so too are expectations rooted in what you can see and what you can price now. What I mean by that, I've got a slide that shows you some of our illustrative examples of either names or ETFs that we think deserve attention based on who wins the White House. I stress illustrative. The audience will have many more names and many more ETFs. That's not my point. I just want to bring light to the fact that, for example, for the last 3 years, the U.S. has proven to itself not only can it not fight 2 full-scale wars in different theaters, it's having a hard time replenishing what it's given to allies in the Middle East and Ukraine. That means at least a 2 or 3 year replenishment of U.S. stocks. So the things that are in inventory go to the allies. New stuff will be kept in new inventories. My sense is that that provides an underpinning for XAR, the Defense Aerospace ETF. But if you dig down further, for example, Harris has said she would like to continue the idea President Biden started of investing in defense industrial base. His number was 60 billion. If you get something like that in terms of a follow-on, I would imagine that the defense sector is going to, from a valuation basis, receive some attention, maybe not as hot as it was in the consolidation days of 1990 through mid-92, but certainly more than the primes have been shown love in the last 3 or 4 years. XAR has outperformed most of those primes. That's one to pay attention to. And I'll just quickly run through another idea that I don't think changes at all based on election. Banks have 4 policy reasons now that provide them tailwinds, especially relative to expectations a year ago. So we have a resilient economy in the U.S. That's good. You're in a rate cutting cycle. For how long and how deep, we'll find out over time. But both of those 2 factors produce business for banks that probably wasn't there before. You then look at the issue of reserve ratios, both Basel III and domestic. If Trump comes in, it's unlikely Basel III is going to be implemented by the U.S. And if it's not implemented here, it's unlikely to be as powerful as this banking supervision in Basel would like it to have, the committee in Basel would like it to have. And the domestic reserves, Powell has made clear that it's not going to be as onerous as originally proposed by Vice Chair of Supervision Michael Barr. So that's capital relative to expectations a year ago that banks have to put to work. We like KRE and KBE also because beyond those 3 points I just made, and I'm stretching for the final point. Oh my gosh, I can't believe it escapes me. I'm not going to waste your time, but there's a 4th point, and I'll come back to it when I can. Oh, it's provisioning. So you remember after March 2023, both the Federal Accounting Standards Board and the bank regulators gave all banks leeway until the end of the second quarter 25, where they didn't have to mark their available for sale and held to maturity books. They'll have to do that, but in the meantime, most banks have been provisioning, so that's unlikely. I liken it to Y2K. The preparation probably is going to avoid a worst case outcome next year.
And just for anyone kind of following along, again, Kim was mentioning that, you know, some of these examples were illustrative, but just to kind of shout some of them out, he's mentioning here, at least when it comes to former President Trump, we've got housing GSEs, looking at the policies around Tesla, big tech, the digital coin system. So of course, looking there at Bitcoin, you've got your spot Ether ETFs, and then the Russian sanctions. And then when we look over at Vice President Harris, we've got residential construction, defense manufacturing, which of course Kim just kind of went through in a little bit more detail, as well as those charging stations for electric vehicles and also elder care. Now, of course, each of those has a corresponding ticker. And if you go look at his slides, you can see those tickers. And of course, you can naturally kind of extrapolate out some of those ETFs or funds that might be impacted. For anyone that wants the easy way to do it, just go to ETF.com, type in the ticker, and we'll show you all the funds that are going to be related to that particular ticker. Now, I kind of really quickly want to, because I mean, again, we could probably spend a whole hour on just this. So I kind of want to ask you, Kim, because you talk historically about how the 2016 and 2020 elections have gone. You've looked at some of the swing states. Kind of, I have to ask, this has to be asked at least once in this entire webinar. Yeah, you might not be able to answer it. You probably won't, but I'm going to ask it anyway. What do you think we're going to see in this 2024 election based on what we've kind of seen historically? If you had to have a crystal ball, do you have an early stage prediction on which candidate you think might clinch victory here?
So we avoid the predictions word, but I do have a view, an outlook, and there's a slide in the handout. It's got a lot of red and blue columns in it that gives you our take. So I'll start from the top down. We expect a divided government with both trends and latest information still favoring Harris at the national level and very competitive swing states. The reason I fall with Harris at the top is a simple market share. As you can see on that slide, Trump lost, or Biden took 5 swing states in 2020 that Trump had prevailed in 2016. It added up to about 72 electoral college votes, those 5 states, almost exactly the 74 electoral college votes by which Biden bested Trump. So Trump has got a market share issue. He's got to grab some of that back. Those states are very competitive. Obviously, no predictions because they're all within margins of error. But that's the challenge. The popular vote loss by Trump was 7.2 million. Electoral college was 74. He's got to gain some of that back. That's his challenge. Obviously, Harris's also challenge to maintain some of those gains Biden got. And we could spend a day talking about the various factions and who favors whom. I won't go into that here, but if you look at the middle panel, I give you my view on the Electoral College, the Senate, and the House, Republican outperformance, close outcomes, and Democratic outperformance. If you just glide across those rows, you will see there's a lot of closeness there. We are likely going to have tight margins after this election, if only because that's the way it's been going the last 10 or 12 years, and that's what the data would indicate now. Surprises, of course, are available and may come to pass. My guess is that we will know sometime the middle of the day on November 6th, if not sooner, who's won. And of course, there are vulnerabilities of that call that we could spend another day on, and I'm not going to do that here. But that's our base case and the reason for our base case.
Now you talk about those tight margins, so I kind of want to swing more into some of these like macroeconomic implications. And so, Kristina, I kind of want to come to you. So as we're just kind of hearing Kim say, right, some of these margins are incredibly tight. And I think that's probably part of the reason why we often hear that markets look right past elections, right? And they continue to power on anyway. I'm curious to know if you think that that's going to be the case this time around. 2024 is very different than 2000, for example, for a lot of different reasons. And especially because I feel like I've seen just so much headline-based reactions in the markets lately, a lot of headline, fueled market volatility. So what are you kind of seeing for on November 7th in the markets, November 8th, and then perhaps even a little bit past that into 2025?
Well, Kristin, Kim said it very, very clearly. This looks tight. And so let's assume that it is a very tight election. That probably will lend itself to some challenges. And so I would anticipate in the near term very significant volatility. I think that, markets would most likely react with some level of concern. We had the IMF issue a warning today about this issue, that there's a fragility, that there could be a shock to markets depending upon what happens with the US presidential election. But that is the very short term. And so I want to make a big differentiation between the very short term, which really doesn't matter for investors who have a long time horizon. It's just something they need the intestinal fortitude to get through, versus the longer term, which I think will have very little to do with the US presidential election and will be driven by other factors, most notably the Fed and what's happening there. And luckily, we are in the midst of an easing cycle. We're at the start of an easing cycle. So that to me is a far more important driver, although I recognize that we could have some very, very significant, very serious near-term volatility.
So then looking at 2025, what are you seeing as because we have seen, well, and I guess I'll actually jump ahead to this kind of question, because there was a lot of headlines a couple weeks ago, a couple months ago. And I can't remember now if it was JP Morgan, if it was Morgan Stanley, I can't remember, that came out and a lot of noise was made about it, about GDP implications based on presidential candidates. Vice President Kamala Harris even mentioned it in her debates. I'm better for the economy. Research has come out and shown that I'm going to contribute more to GDP growth than, the former president. Is too much made about that kind of headline, do you think? And then what are you kind of seeing then for the US economy going forward, just in general?
Well, that's a great question. I would say for the most part, too much importance is placed. And my argument for that is that really this economy is being driven by so many different factors. Now, having said that, you can see specific policies having an impact. In fact, the Biden administration's industrial policy has driven up construction spending. The CHIPS Act in particular, but we've also gotten two other pieces of legislation that are contributing to infrastructure spending. That is certainly having an impact in the shorter term. We saw fiscal stimulus during the pandemic having an impact on the economy, really making it as resilient as it was. So I don't mean to diminish that policy has an impact, but I think we need to distinguish between what can be accomplished in a divided government versus what can be accomplished in a sweep. If we look back at recent history, it's the pieces of legislation, most of them get passed when there's a sweep, when there's Congress, or at least one branch of Congress, that can support a president's agenda. Far less can get done when the president is not supported by a Congress of the same party. And so I think we also have to factor that in. So if we think about Kim's different scenarios, more can be accomplished when there's a sweep, but that seems less likely, just given, again, how tight this race is. So then we have to ask ourselves, what could possibly get passed that could garner bipartisan support? And I default to executive actions, that is probably where, if we have a divided government, we'll probably see the most in the way of policy. Then we have to ask ourselves how much of an impact that would have.
Are you seeing any potential executive actions that could come from either candidate that you think could actually impact GDP outlook in 2025, 2026?
Well, tariffs. I think that would have an immediate impact on markets in terms of boosting volatility, but it could certainly have an impact on GDP. So that's one example.
And Kim, I kind of also want to come to you a little bit just because Kristina is mentioning again Congress, which we obviously titled the name of this webinar the presidential election. But there is also a congressional election happening at the exact same time. And just as Kristina was mentioning, how much a president can actually get passed or actually push their agenda forward does depend on who controls the Senate and who controls the House. Could you, I know you mentioned it, I know that you have like a chart on it, but could you kind of quickly kind of summarize here really sort of what's at stake in terms of the potential scenarios, what's most likely, what are you seeing right now in terms of that congressional election impact on both markets and then also GDP going forward?
So bluntly put, control of the House and the Senate is what's at stake, and it'll be a narrow outcome more than likely. In our view, the Senate flips back to Republicans by 1, maybe 2 votes in an outperformance scenario for Republicans, and we have the House flipping back to Democrats by 4 to 6 votes, maybe up to 8 or 10 in Democratic outperformance. Having said that, presidents negotiate with Congress to get anything done. They can't enact legislation on their own. And so I agree wholeheartedly with Kristina on the executive side. The one you look for most is if Trump is elected in tariffs. And, we all know both the macroeconomic and the fiscal history of tariffs. They don't pay for themselves. They do impact consumers and producers in the home country more than anyone else because of retaliation. There will be a nick to GDP if you get anything close to 10% across the board tariffs, and there'll be pain for consumers in the way of higher import prices. Having said all of that, outside of that view, Congress is going to have to do something about the 2017 tax cuts. We know that's coming. My sense is that doesn't lead to a broader fiscal rebalancing conversation. It's just a different flavor based on who's in the White House. And you have to watch the Senate very closely because the budget rules there are very rigid and they are a constraint on looser fiscal policy, at least looser fiscal policy on a net basis. Depends on the types of offsets you're willing to come with. But, if Harris is in office and she has a divided government, I think she's going to push the Senate passed immigration bill pretty hard. My guess is that whomever comes in, we're going to have at least another step or two, if it's not legislation, toward what happens with digital assets. And as you mentioned, we expect action on housing irrespective of the outcome. If it's Trump, he'll look at GSE's conservatorship in the sweep program. If it's Harris, she's already said she'd like to increase the low-income housing tax credit and expand it for other purposes, renovations of single family and a higher value for the credit for multifamily construction in underdeveloped areas. So I agree with Kristina. You don't know what to expect, but you ought to expect that there will be action based on the balance of power and based on the preferences of the 47th president and his or her ability to compromise to get that achieved.
I do want to get to sectors in just a second, but I do kind of want to talk a little bit about taxes just for a moment. And I'd love to kind of bring you in here, Kristina, about that, just about taxes, because we have heard a lot about it. I mean, we've heard about Mark Cuban coming out against Kamala Harris and her plan to tax unrealized capital gains, which I know every investor, whether you are an advisor or you are a retail investor, you are definitely going to care about. Do you see any kind of tax? And we were talking about tariffs a second ago, so that was a different set of taxes that we're talking about. But do you see any sort of tax implications, at least domestically, that you think could impact investors, advisors, but then also the economic outlook?
So I think the focus of attention for many investors is around the corporate tax rate, right? Because we have two very different perspectives, two very different policy platforms for the candidates when it comes to corporate taxation. And so I think that if we were to see an increase in corporate taxes, that might cause some short-term jitters. Of course, that would be a Harris administration that would support that. But we went back in time and looked at every instance in which the corporate tax rate was increased, just to see how it impacted the stock market that year. And interestingly, we found out in every year in which the corporate tax rate was increased, the stock market was up. Now, there were years when it was below the overall average for the S&P 500, but there were years when it was above, and we didn't see any negative years. Do I think that means that stocks like an increase in corporate taxes? Absolutely not. But I think that's supportive of my point that there are far more factors that impact stocks than just that. But I think that would be one issue of significance for investors and could very well create short-term headwinds for the stock market. But again, nothing that I think would impact investors with a long time horizon. The other area, of course, is where we get tax cuts. And I think the running assumption, although Kim is the expert on this, is that in a Harris administration, in a Trump administration, we'd see a desire for the extension of all the tax cuts passed in his first administration, the TCJA, whereas a Harris administration would likely only be supportive of continuing the tax cuts for households earning $400,000 or less, which was a standard that the Biden administration has used for a while. You know, that promised no new taxes, no more taxes for households under 400,000. So that to me could be, could at least not create more headwinds. I think it's really important, though, when we think about any kind of fiscal spending, and tax cuts are fiscal spending, we actually think about the multiplier effect and also what the goal of the policy is. Sometimes policies are intended to be very stimulative. For example, during the pandemic, PPP was intended to be very stimulative. That's why it was designed to get into the hands of consumers immediately and get spent. But sometimes there are other policy goals as well. But we have to recognize that we're deficit spending every single year. And even Keynes didn't envision that. He anticipated deficit spending during crises. So we have to ask ourselves, whenever there is fiscal spending, especially deficit spending, what's the multiplier effect? What's the payoff? And is the cost benefit analysis worthy of having that? Now, that's not a discussion that I think is happening anywhere, but I do think it's important. And I think we're on the cusp of seeing more and more bond vigilantes, more and more concern about the growing debt situation in the US and a lack of fiscal prudence. So I think it becomes a bigger issue. So that was a long way of saying, when we think about the multiplier effect, it is higher for low-income tax cuts. So for low-income households, the conventional wisdom is that they spend more of what they get. And so any kind of tax cut will make its way back into the economy more so than if a higher income household were to receive tax cuts. So I think that depending upon where we see the tax cuts, that will have a greater effect on the economy or a smaller effect on the economy.
Now, we did get an audience question, and it's one that I'm going to just say it, but it's one that I actually think that we're going to have to repeat throughout this conversation. And then I want to kind of get into really looking at sectors. And the question was this: when the new president is elected, when would you see changes time-wise? Now, I'm not entirely sure what this audience member meant by changes, so I'm going to input some words for the changes. I'm curious to know how long you see in the near term volatility in the markets when we do get that new president. And then I'm going to ask kind of later, because we talk about sector dispersion and on a time horizon, and I knew Anu has a chart about that. So I do want to get into that. But I'm going to just throw this quickly out there just for this piece, at least when we look at this kind of looking at the markets. How long? What's that time horizon, do you think, of the volatility? You called it, I think you said it was intestinal fortitude, Kristina, that investors are going to have after the markets, because we're going to see volatility. How strong does that fortitude need to be? How long do you kind of see the markets wobble a bit based on these election results?
Well, we are creatures of our recent experiences and the biases. And so I would imagine that investors are going to be most concerned about the period between the election and the day in which the election is certified in January, just given the course of events in 2021 that we saw. So that would be my expectation, is that that's when investors will be holding their breath. That's when we're likely to see more volatility. But also, a lot will be driven by the rhetoric we hear. A lot will be driven by events that may unfold, hopefully won't unfold over the course of those months. But I would anticipate that we probably see heightened volatility for that period.
So that's 8 weeks, guys. For everyone that's watching, that's 8 weeks that you need to hold on and hold on to your lunch for the roller coaster ride that we're going to be going on. Now, again, I mentioned that question is going to come up again later on. So I do kind of want to dive into a little bit about, portfolios now. Anu, you've done historical analysis. You have charts where you're kind of showing the past two elections, the sector risk. Could you walk us through kind of what you were seeing in 2016 and in 2020, what you kind of have found in the past, and really
Sure.
those findings? Oh, I'll jump to that in a second. Let's just walk through some of that historical analysis.
Yeah, no, absolutely. I think 2016 sort of set the stage, right, from looking at history. But we actually stumbled on something which was pretty fascinating, which is, you talk about risk, you talk about volatility. Dispersion is a measure of cross-sectional volatility, right? So the magnitude, the spread of returns within an index. And what you can do is you can measure dispersion within sectors, and you can also measure dispersion across sectors. And what we did is they sort of have this Pythagorean relationship where you can understand what percentage of the total market's dispersion is coming from sectors. So what are these cross-sector effects? So the long-term average is roughly 22%, right? On average, 22% of the market's total dispersion was coming from sectors. But we found this interesting seasonality effect, which is the strongest effect occurred in November's, which happens to be the month we're all talking about right now, right, with congressional elections and presidential elections. So what we did is we actually took it a step further, and we took our database and divided it into presidential election Novembers, congressional election Novembers, non-election Novembers, and non-Novembers. And we found this nice linear relationship where the cross-sector effects and the sector dispersion, which you see on one of the slides, was the strongest in presidential election Novembers and congressional election Novembers. So if you're thinking, well, why does this matter, right? So what? The dispersion is greater. The reason it matters, we believe, is there's greater potential opportunity to add value from sector allocation decisions. And I do caution that the greater opportunity doesn't necessarily translate into actual outperformance, right? So with that caveat, if you're a sector rotator, if you're a sector allocator, we think this November is potentially an opportune time given the historical record that we've seen.
So then for anyone listening to that, right, is this like one of those things like November 1st, they need to start looking, or is this a time, or is right now, right? We're, like I said, 2 weeks out, is right now really the best time, even perhaps to start positioning yourself accordingly for that kind of what you're saying we're going to be seeing throughout that month of November?
Yeah, no, I think the time horizon is important. And just stepping back and looking at annual returns, for example, if you look over the past 24 election years, right, the S&P 500 was positive in 18 out of those 24 years. So that's a roughly 75% hit rate, right? But if you look at the best performing year was 1928. If you think about that, right, way back. The worst performing year was 2008, and there was a roughly 75% spread between them. So I think that really highlights the point that every election year is different. Every year is different, and you really have to look under the hood. So that's from an annual perspective. You could even take it more granular and look at quarters and look at Q4s. And we looked at the average Q4 in election years, which was pretty similar to the average Q4 overall for the S&P 500. and similar to the average quarterly return. So far, historically, we've seen that the election years have behaved very similarly from an overall market perspective to non-election years. But again, if you dig under the hood, there's a lot going on from a sector perspective.
So I have to ask, because I know that we're looking back at history to kind of, make some kind of, not predictions, but really kind of to think intelligently about where we are now. But we have seen markets perform very differently over the last 4 years than I would say that they've kind of performed in the past. And we've also heard so many times people saying, ugh, what happened in the past, we cannot use right now to really talk about what's happening right now. Now, granted, we had COVID. There was this black swan event that we've kind of experienced over the last couple of years. But, we've heard like this recession recovery is different than past recessions and different than past recession recoveries. So I have to ask then, what are you seeing that could perhaps be different in this 2024 election than what we saw in 2016? Or do you think that they are fairly similar and that the ways that we can kind of approach the markets this time around can be similar to how we can use that kind of historical analysis for this time around?
Yeah, no, and that's an excellent question, right? Because every year is different, and you're right. There's so many different curveballs, so many different uncertain factors, not just the election, but step back with the 30,000-foot level. I think Kristina talked about the Fed earlier, right? There's a lot of different uncertain factors at play. So I think history can act as a guide, right? A guidepost. And going back to the points earlier that you and Kim and Kristina were talking about with split versus united governments, we looked at that as well historically, and we looked at the Dow going back to 1896, right? Very different circumstances from where we are right now on the S&P 500 going back to 1920, and we looked at the average 2-year returns, looking at the final trading day in October over the subsequent 2-year period. And we found historically that the average, those 2-year returns tended to be higher during united governments versus split governments. So I think that's something to think about as well. It's not just the outcome of the presidential election, but control of the House and the Senate, which we talked about earlier.
Now, I want to ask about risk, because you have a really nice chart about the S&P 500 sectors, and you were talking about the 2016 election. And they're kind of all clustered kind of similarly together around election day, and then we see a big breakout. So can you talk us through in terms of sector risk? Are you still seeing that kind of sector risk this time around? Are you anticipating the same kind of spread? Because I'm looking here at this chart, we've got, I think it's utilities all the way at the bottom.
That's right.
Got
That's
financials
right.
all the way up at the top of that chart. So how are you kind of looking at sector risk in this 2020?
Yeah, and as we sit here right now, the S&P 500 is strong. We've seen the record highs. We saw the rotation into smaller caps in Q3, and then the recovery of large caps since then. So a very interesting vantage point to be sitting at right now. From a risk of volatility perspective, we've seen that the VIX has been relatively elevated as well in the midst of this rally, which has been interesting. Talking about risk and sectors, we actually have an implied dispersion, again, talking about dispersion index called DSPX, and that has been relatively elevated as well. Which kind of makes sense given that we're, coming off earnings season right now. There's been a lot of idiosyncratic risk going on. So from a sector point, we've seen financials have been the strong performer month to date on the bank of strong earnings. But the question of what will happen afterwards, right? The question going back to the chart that you mentioned in 2016 remains an unknown. But the data really shows us that we can expect the contribution of sectors to dispersion to remain relatively high if history is a guide.
And you mentioned it before, but I'll kind of just bring this question up again. Again, this was the audience question of essentially that sort of time horizon. Again, the question was, when the new president is elected, when would you see these changes time-wise? So let's just talk about it. Let's put in sector change, right? What is the time horizon there? I know you mentioned November. Does it continue after that? What are we seeing in December, January, and then the following year?
Yeah, it's a good question. And, Novembers have certainly been important. I think, it's important to look across the cap spectrum. We've talked a lot about large cap sectors, but, another interesting tidbit for you is if you look at mid and small caps, for example, we actually found that the cross-sector effects were higher in congressional elections, perhaps because mid and small caps are more domestically sensitive. So important, I think, to look at the entire cap spectrum. So while Novembers may remain important in Novembers for the large caps, perhaps for congressional elections, mid and small caps could potentially be in favor. As to the question about the other months, I think that's something that we're all closely watching, given all the uncertain variables at play with macroeconomic uncertainty, uncertainty over the Fed and whether we're going to see rate cuts in November, uncertainty over inflation, and by the way, global. I mean, we haven't talked about, global uncertain factors and thinking about China, for example, and we've seen the divergence in U.S. and China performances in the first half of the year. So there's a lot of things at stake here.
I'm actually, and by the way, Kristina, we can still see you. Don't worry. I know that the climate change lights went off on you, but we could still see you. You're still well lit. I'm actually glad you mentioned that globally. And Kristina, you are the chief global strategist. So I kind of do want to ask you, looking at that, because emerging markets has been such a huge topic, especially lately. We've seen a lot. China has come up with a stimulus. They've been light on details, but they apparently have a stimulus plan for the economy. India has been of incredible interest lately. They've recently had elections. Do you at all see a kind of global impact? What are you anticipating globally next year, especially for those investors that perhaps are looking to emerging markets and have emerging markets in their portfolio or looking to add to their portfolios next year?
So I'm going to make a very strong argument that the most important factor for the global economy next year is central bank easing. I mean, we're in an environment of pretty significant easing. Reserve Bank of New Zealand gave us a 50 basis point supersized cut last week. We're probably going to get one from Bank of Canada this week, and so on and so on. And I think that's going to be an important driver. Certainly, we love stimulus, and the stimulus from China should be supportive of a reacceleration in global growth as well. But to me, that's really important. Could there be flies in the ointment, like an increase in tariffs? Yes. But I think the overall picture for me is a positive one for the global economy, and it's driven by factors outside of the presidential election.
And Kim, I want to ask you, because we have heard both candidates primarily focus on domestic issues, at least in 2024, very different from what I would say we saw back in like 2008, where there was a much greater focus on geopolitics. But are you seeing any sort of policy implications on a global scale in this election? I mean, we have tariffs, but are there any others that you're seeing? And you're muted right now.
I believe so, but I want to comment on what both Anu and Kristina just finished saying.
Yeah.
It's the fundamentals, folks. Once you get beyond electoral risk in the U.S., whether you think it's my window of the first week or the end of the first week of November, or you think it stretches out until January 6th, the actual seating of the 119th Congress. Once we get beyond electoral risk in the U.S., both company and macroeconomic fundamentals, particularly from the U.S., will dominate all of what we talk about. In terms of policy in 2025, the next president, when he or she is inaugurated that afternoon, will probably get a brief of what's going on in geopolitics that will sober them. Even if it's Harris and she got a brief the day before, it's still going to be a sobering brief on that day, January 21st. Geopolitics will consume a lot of the first quarter. What's the trajectory in the Middle East? Clearly, Iran is isolated in many ways. You can make a case that Iran is as vulnerable or weak as it's been in a long time, and that stakeholders in the region, Saudis, UAE, Jordan, to a lesser degree, Qataris and Egyptians, all want something different than's happening now This is, again, capital being the chief input in geopolitics in that region, and it's becoming more of a dominant force. What happens in Ukraine, I think, will have a good indicator based on the election outcome, but also then first quarter decisions. You don't get to fiscal policy, even from a conceptual basis, until after the State of the Union and the next president's amendment of the outgoing president's budget. That's March, April, May committee action, but nothing that really narrows the field or the size of the table of negotiation. And so my guess is that's when you'll see, depending on the outcome, social policies pop back up, especially immigration. If Trump is in, this is when you'll start getting a better sense of who has filed petitions with the USTR and the Department of Commerce that could lead to a finding by one of those agencies enabling new, different, higher tariffs. It's the second half when we get into fiscal policy. That's a very simple back of the hand, quarter by quarter look at what we expect for 2025.
I'm glad you mentioned the Middle East, because even though we have had an oil production glut, which I think has actually kept some of the volatility a little bit contained, we have seen oil prices on a, I think, even more wild roller coaster ride than they typically are lately. Of course, waiting on OPEC to decide about those production cuts, if they're extending them further, and that will impact those oil prices going forward. I kind of want to get back a little bit to some of the, again, some of the sector stuff that we were talking about. So I know that there was some performance changes, at least when it comes to the S&P 500, when it comes to elections, particularly in the fourth quarter, right? That last quarter. So I mean, do elections matter? Yes, on some level, clearly they do. Could you talk a little bit about what you found and how then you think an investor should kind of navigate around that?
Yeah, no, it's fascinating because, you talk about quarters, you talk about different time horizons. Like I said, the Q4s that we saw during election years behave very similarly to the other Q4s and to overall quarters, right? So not much difference there. But going back to your point on sectors and thinking about risk, right? You can think about, sectors as complements to the rest of the market. And one example for you is energy. I mean, we've talked so much about energy. Kristina was talking about oil earlier. We heard from Kim about, energy as well. And if you think about the energy sector historically, right? And we haven't looked at this specifically in election periods, but we've looked at different regimes. And sometimes the energy sector was moving very closely with the rest of the market, right? And other times the energy sector was marching to a different beat, right? And doing its own thing compared to the rest of the market. And in the latter case, when energy is off doing its own thing, perhaps we could expect the correlations between energy versus our S&P 500X energy index to decline. And perhaps energy could act as a diversifier compared to the rest of the market. So important, I think, to not just keep the return dynamics in mind, which is super important, but also thinking about sectors as building blocks historically and how different sectors, energy is just one example. You can think about information technology, how they behave, and complement each other. It's pretty interesting.
And we actually do have a question from the audience. I'm going to read here. So we were talking about energy. Now, they were specifically asking about defense ETFs, but I'll kind of broaden it out here about how Trump might impact the defense sector, or if there's any thoughts here on how defense sectors might be impacted going forward, depending on the election.
So I'm happy to jump in. Oh, sorry. I know I didn't.
Go ahead, Kristina.
Go for it, Kristina.
Well, what we saw, thank you. What we saw when we looked back at the history for the defense sector versus the S&P 500 in the Trump administration, defense stocks did not perform as well as they did under the Biden administration. And that goes to, I think, the other factors that impact stocks. And as I mentioned before, we saw two wars, two pretty significant wars erupt during the Biden administration. And I think that's the reason why we saw defense stocks do so well. So all else being equal, I think there's an assumption that a Trump administration would spend more on a defense budget, but there's really no way to control for wars and conflicts erupting around the world.
I didn't know if you had anything to add in there, especially that what you guys have seen on a sort of sector basis within the S&P 500, particularly around defense.
Yeah, I mean, nothing specific to defense, but I will say that sectors evolve over time. You know, and I'm talking about 1896 here. I mean, we've seen a lot of changes since then, right? And you think about, you know, our gig sectors. We now have the communication services sector, and you know, back in the day, it was the telecom sector. So the way technologies continue to evolve, the way we get our exposures continue to change. So important to kind of adapt accordingly as we look at this history.
I have another audience question.
Can I just
Yeah, go ahead, Kim.
Kristina's thought? It is the case that former President Trump's advisors are in step with him on wanting to see a lower projection of hard power of the U.S. This gets back to Kristina's observation that less was spent during his path. There is a relationship Trump has with Putin, which will allow Trump, if he gets back into office, to have the U.S. become less of a interlocutor, if you will, globally, particularly with hard power. So I would tend to believe that, consistent with the views on Ukraine, Russia, Trump back in office, stable funding for defense, particularly the replenishment piece I spoke about earlier, but not so much the defense industrial base investment, and obviously not the continued financial and other support for Ukraine. That'll ding defense spending.
So I do want to get to, because we have about 5 minutes left. I have like 150 more questions that I could ask you guys. So I'm going to try to go for an audience question, and then I'm going to end it on the election, Republicans versus Democrats, when it comes to index performance. The news got a really great chart on that, and I want to end on that one. So I'm going to go to this audience question first. And it's about buffered ETFs. Now, we've seen the rise of buffered ETFs recently. There are obviously a lot of folks are adding them to portfolios to really kind of increase their defensive positioning inside of their portfolio and protect against any volatility. So the question essentially is this. There's been little emphasis on Trump's promises of high tariffs. What about buffered ETFs to protect? And so I guess broadening out that question, if you guys are seeing a need, looking at you, maybe perhaps Kristina or Kim, about this need for this sort of defensive positioning in a portfolio against the kind of impact that those tariffs might have. I know, Kristina, you mentioned in the near term, there could be a pretty sizable impact.
Yeah, I think that investors should be thinking about a variety of different tools to offer diversification and dampen volatility in portfolios. So tools like buffered ETFs make sense for a lot of portfolios. So does gold. And interestingly, we've seen this phenomenon where stocks have gone up and gold has gone up. You know, historically, there hasn't been that correlation. Usually it's a risk-off environment. Your gold is up, and if it's a risk-on environment, stocks are up. But now we're seeing that as one way to hedge geopolitical risks. But I think buffered ETFs and make sense as well. And there are a whole host of other asset classes with lower correlations to equities, and that I also think makes sense to have a well-diversified portfolio.
And GLD, as you were mentioning, GLD is the largest gold ETF, hitting record highs today. Gold right now marching right towards $2,800 an ounce. I haven't been to Costco lately. Apparently, there's long lines, people buying gold bars at Costco. And we've already heard of Costco earnings have done quite well because of those gold sales. So we only have 2 minutes left. So I'm going to end the question on this with a news chart here, which is essentially there are differences based on Republican and Democratic candidates and their impact on the Oh, it's the Dow. I should actually mention it's the Dow. We also do have, I think you also have the S&P 500 in terms of the average 2-year return. Walk us through this chart. It looks like the Republicans are edging out Democrats, at least when it comes to index performance.
Yes, no, I love this chart, and I was alluding to it earlier when, Kim was talking about split versus united governments, because, the more data points we get over time, the more history we have to analyze this different regimes. And I think the key message that the visual shows is that historically we saw average higher returns when the government was united, regardless of Democrat or Republican, versus split. Which I found pretty interesting. So like I said, none of us have a crystal ball or know, what's going to happen. And we have a lot of uncertain factors at play. But I think that'll give us another, toolkit along with the dispersion, along with the sector performance to just understand these different congressional regimes and how the market reacted.
And I should mention, just for anyone who doesn't have the chart up, at least looking at the average 2-year return, a fully Republican sort of House, Congress, and president, we've got better returns in the Dow. S&P 500, however, seems to do better when we've got a fully Democratic administration, when the Democrats are fully in office. So we will leave that there and let everyone draw their own conclusions about what we could be seeing for this election. Again, we are sadly at time. I've had so much fun chatting about this. Like I said, I could easily chat about this for another hour. I want to thank Kim Wallace, again, Senior Managing Director, Head of Washington Policy Research at 22B Research, and Ganti, U.S. Head of Index Investment Strategy for S&P Dow Jones Indices, and Kristina Hooper, Chief Global Strategist at Invesco. And I want to thank all of you for sticking around with us for the full hour and for listening to us talk about elections and the markets and the economy and more. Thanks so much for joining us for today's conversation.